stop being shorted for the day. I've had a lot of requests for a video about stocks and investing. A little bit about me. I'm a day trader. I've been day trading for 7 to 8 years. And I tell everybody I've never sold a loss, and I'm going to tell you why and how later on. But first of all, let me tell you about Boston Enterprises Investment Group. It's just a page on Facebook, nothing major. I just put out financial advice and things to help people grow and become better. So today we're going to be talking about what are stocks and what do they do. Now while I'm writing this, y'all take a second. You might watch this on YouTube, you might watch this on Facebook, I don't know. But you can like, subscribe, share, follow, comment. Comment. So at any point in time, well, this isn't live, but if you have a question about anything related to stocks specifically that you want me to cover or go into more detail about, leave a comment and just let me know, and I'd be happy to make a video or, respond if it's something small and clarify that for you. Alright, so the things I'm going to talk about today is what are stocks? So, stocks are shares of a company, and people think that when you own shares of a company, you own part of the company, which isn't true. So what happens is, or what it's not is, if I own IBM, let's say I own 33% or 33% of the shares of all the shares for IBM, right? I can't just walk into IBM one day and grab a chair and walk out and say, hey, I own a third of this company. No, you only own a third of the shares for the company that have been issued. But you do not own the company. And I'm going to talk about why companies issue stocks and why people buy stocks. So, why buy stocks? Why buy stocks? The main reason is for increased value, right? So capital appreciation. You buy a stock, and let's use let's say Dunkin' Donuts. You buy Dunkin' Donuts, and let's say, I don't know the actual price today, but let's just say it's $26 a share. Well, you think about appreciation, you're buying this with the hope that it's going to take off and go up, right? And you can sell it later on for a profit at, let's say, $30 a share, or, if you're lucky, $7 a share. I give you an example, Amazon, which is AMZN is the ticker. I go into what's tickers later on. Amazon started off, a couple dollars a share and has grown, historically from 100 to 250 to, 500 to 1,000 to 1,400 to 1,600 as of today. It was at 1,625 last time I checked on it. So, they say, well, if you'd have bought Amazon 5 years ago, you'll be a millionaire. So, you might want to get in on it at $250 a share and sell it for, $16.25, for the difference in profits. So appreciation, that's one of the reasons, right? The second reason is dividends, okay? Dividends are when a company makes money and they give you a kickback, basically, on what they earn. So, let's say Best Buy, for that quarter earnings, they were, $25 million in profits. And they say, okay, we want to thank our shareholders, and so we're going to kick them back let's just say they're $50 a share. We're going to kick them back, $3 per share, or, maybe something like $1 per share. So, and companies issue out, millions and millions of shares. So for every share that you have of, Best Buy, you would get $1 per share. So if you have 100 shares, you will get $100. Or if you have, 20,000 shares, you'll get $20,000. Dividends, and they're usually paid out. Some are paid out monthly, some are paid out quarterly, some are paid out yearly. That's another reason. Some people just want to put money into something. They know the value of the stock is going to go up, so it's going to be a slow growth. So it might not go as fast as Amazon, but by this time next year, if you got a lot of shares, it makes a difference. This might be at $60 a share, but it's paid out, $1 per share quarterly. Which, if I had 100 shares, that would have been $100 every 4 months, which would have paid. Every 4 months would have been quarterly, which would have been another, $400 on top of the value of the stock going up. And I had 100 shares, and it's going up $10 a share, which would have been an extra $1,000. So your total profit would have been $1,000 or $1,400 at the end of the year. So not all stocks pay dividends. I don't know if Best Buy pays dividend, but that's just the example I use. So you would have got that normal growth from the stock going from $50 to $60 a share at $100 a share. For 100 shares, plus the dividend that they would have been paying you out, which can be reinvested into more stock, and you just keep that in your pocket. Okay, so the other thing is influence. So as far as influence, you can get rights to kind of have a say-so on what the company is doing. Not really a huge, I don't like this, or I want to do this kind of thing, and I can control what they're doing, but you get a vote. You get to vote. You get to vote on some of the decision making, the chairman, the board, directors. You get to say so in whatever they give you the option to vote in. And so let's say they want your opinion about something. They'll send out a letter, and I don't know if I have one laying around, and they'll give you this thing where you can go online or call in, and they want you to vote on certain things that's going to happen and change and affect the company. So those are the 3 reasons why people buy stocks. I would say mainly it's because people want to make money off them. They think they're going to go up, and so they want to buy them and hold them until they appreciate. So I will give you 3 examples of how that works. And I'm going to use a shoe, a Jordan shoe. I don't know, something like that. Then I got that thing down there, and then the Jumpman, which is like, it's something like that. Let's see. The ball. So let's say, I don't know. Let's say a Jordan shoe, and let's use what comes out. Let's say it's a PlayStation 4, which I don't know how they look, but it's something like, it's a lot square. PS4. I should have did Xbox. Well, they don't have cords no more. Alright. So what happens is demand is high. Well, let's say demand is high. Let's say you go to the store and to buy a Jordan shoe. And a Jordan shoe is normally, I think $100 or $150 or something. It's $100 for a pair. right? And the PS4, I'm gonna say is like $250. I'm not sure. So what happens is, you get the shoe, you have it, you hold on to it, and you don't want to wear the shoe, you don't care about the shoe, you don't know anything about the shoe, but you do know a lot of people want these shoes and they do care about these shoes, and so you know when this shoe comes out or it's going to sell out, and you know that a lot of people are going to want it later on. And so that's how stocks won't work. I might buy the shoe now or the stock now in hopes that tomorrow, when everybody realizes, and it's going to be the same thing for both of them, and hopes that when it sells out, people are going to be like, I really want this PlayStation, or I really want this Jordan shoe, and they're going to be, the value of it goes up. It's supply and demand. Supply is down, they're sold out, there's no more, because stocks are issued one time. When the company first does that initial public offering, it has a certain number of stocks they're going to sell. Let's just say it's 25 million. Once those 25 million sell out, that's it. It's just those same 25 million constantly changing hands between people and people and people all over. They're constantly changing hands back and forth. The same stocks. So, shoes sold out. Now I have a pair, and I'm just like, and the value's going up. So people are like, hey, you know, I'll give you $150 for that same pair that you already have. And I'm just like, oh, $150, you know, that's like a $50 profit. So I'm just like, okay, yeah, no, I think I can get more. So I'm gonna hold out for $200. Same thing with PS4. They only have so many. It's Christmas time. You know, people are gonna get kind of desperate for them. I'm marking it up to 1,000. So that's what I want to sell it for. So what happens is, when the value keeps going up, and people realize that you know, there's the company saying they're not going to make any more, so the value just went up, or things happen to influence the price. And so now people are getting to that point where they're like, well, I can't find it anymore. I got to pay this price. And that's where I'll come in and make my $100 profit, because I bought it for $100 and I sold it for $200. Same thing here. I bought it for $250 and I sold it for $1,000 for a $750 profit. Or $100 profit. Alright, can't think right now. So that's how a stock works. So I'll give you an example of Amazon today, because I just sold it. The stock was, early this morning, it was at about, where am I going to put it? It was at about 1,400, somewhere around there. And let's say, why don't I do shares? By the end of the day, the earnings call came out, which means that they did a quarterly earnings report. They said, you know, we made such and such amount of profits, which was in the millions or something. Millions more than they expected to make, or anybody expected them to make. So what happened with the stock is, and I could pull it up and show you guys, but I'm just going to do a graph. What happened is, it was here. You can go look this up. It's I think today's the 26th. Today's the 26th of April 2018. The stock was down here in the 1,400 mark, and it went up, you know, a little bit today. And then here, when the market closed, that's the close of the market. This is the open market. When the market closed, the earnings call came out, and their expected earnings per share was supposed to be like 127 per share, and it ended up being 327 per share. So the stock went up to 1625, and right now it's floating at that area. I think it was like 1620 last time I checked. But so the revenue went up, the value of the company went up, the overall value went up. So the stock, which is a representation of the company, went up from 14 to 1625, or let's just say 1600, which is about $200 per share difference. And this actually happened today. So when you have 100 shares, you can just add those two zeros. That's a $20,000 profit that you can make off 100 shares. If you had 200 shares, 40,000. But I don't want anybody to get misled with these numbers. It takes a lot of money to make a lot of money. So if you had the same person, a normal person who only had 2 shares, and they paid $2,800 for it, and it went up to $1,600, they were only able to sell it for $3,200 for a difference of $400, and that's their profit. The same percentages, but that's their profit. Whereas somebody with 100 shares, and this is for 2 shares, and then the same person who had 100 shares made that amount. So it takes money to make money. You can't kind of just get into it and think that you're going to just make a lot of money easily. You have to kind of start low with small shares, maybe $5 stocks, like I can't think of any names of them, but like $5 stocks or $25 stocks. These are what you would consider Google, Amazon, what you consider blue chip stocks, and I'll go into what those are later on. But it takes a lot of money, so to get to this, to buy that many shares, you were already talking about $180,000 worth of shares that you already purchased to make that much on there. So yeah, if you put $180,000 into it, then yeah, it only makes sense to make $20,000 off of it. But if you only put $3,000 into it, you can't complain about $400. That's a good profit. Anyway, so I don't want to ramble too much and get too far off track with stocks. But that's just how stocks work. Now, keep in mind, at the same time, the way a stock can go up, it can go down. And I'll give you the same example of Amazon. If you go back a month ago, when it was already $1,500, $1,600 a share, it dropped when the Dow fell, and a lot of stocks fell. And just as quick as you can make $20,000 or $400, you can lose it within a day, within minutes. You can get in at the right time and make hundreds of dollars or lose thousands of dollars. Or you can get in and nothing really happens, and it kind of just, a few cents here, a few dollars there. Alright, so the next thing I want to talk about is why companies sell or issue stock. So the first thing they do, the issue stock, is because they want to raise revenue, they want to make money. So I'm trying to make it a really long explanation, but let's say I want to start a business. I want to start a lawn care business, okay? I want to get me a lawnmower. Okay. Alright, I want a lawnmower. I want a lawn care. It's going to be Foster's Shrubbery or landscaping. Alright, but I don't have any money. So what I'm going to do is find investors, basically. And I'm going to say, hey, I'm going to sell you a piece of my company, a share of my company, for $10 a share. And I'm issuing out, thousands of shares. What I can do that today, and I tell those people, hey, for every dollar I make, I'm going to give you 10 cents on the dollar. Or I'm going to give you $1 for every dollar that I make as a return on my profits. Okay? When I do that, and let's say I issue out 10,000 shares, right? At $10 a share, you can just multiply that. It's $100,000, right? And I could raise $100,000 to go buy. I don't need a push lawnmower. I'm gonna have me one of those big ones with the circle things on it, and I'm gonna be riding something like that. I'm gonna be running over trees and everything. It's gonna be so big. But so I started company. I issue out shares. Now when I make my profits back, you know, these 10,000 shares, and I say, hey, every dollar I make, I'm gonna issue out $1 per share, or when I have my if I issue out dividends, you know, hey, every quarter, every 4 months, or every 3 months, I'm gonna issue out $1 per share. If you got one share at $10, you get $1. If you got more shares, if you got 500 shares, then you know you will have $5,000 off my profits. And that's how people, you know, they'll get growth off of the shares. But anyway, that's not the point I'm trying to get into right now. Point is, I'm getting out. This is why companies sell stock. It's because they need to raise capital, because they want to make some kind of venture. You know, maybe some kind of new product line, or need to get their capital up to earn money or something. Or maybe they have a lot of debt. Maybe they took out a huge loan to start their company, and and they want to pay that debt off now, so they're going to issue out stocks to sell that. I mean, to be able to pay that debt off. Different reasons like that. So, there's a lot of types of stocks. There are mainly 4. Okay, you have, you have preferred stock. You have preferred stock, and then you have common stock. It's not really a big difference between them. One is just that one is when you're able to vote, and the other one you don't have voting rights, but they pay dividends. So this is like dividends, and this is voting. That really doesn't matter, because you're not gonna be looking at unless you just really want to vote on who or what happens in the company. It's not really that big a deal. And each share is worth a vote. So if you only got like 10 shares and they issued out millions of stocks, I'm not gonna say your vote doesn't count, but I have yet to vote in any stock or for any company that I've owned, and I probably own every one of your favorite companies you can think of. What else? You have growth stocks. You have value stocks. You have blue chip stocks. And you have income stocks. And these kind of categories, kind of like from the last two I was saying, preferred and growth, those are categories, but these aren't the same categories as these stocks. These are like the different type of stocks individually, but then you have what kind of rights do each stock has. It'll make sense later on if it doesn't make sense now. So value stocks are ones you just think are going to grow in value. Blue chips are like the elite, the Google, the Amazon, the I would say Netflix now. That's the ticker. That's the ticker for Google. Well, Google has two. Maybe Apple. IBM. they're more the big names, they're recognizable brands. They're more the expensive stocks. These are probably going to be stocks that cost $300 to $400, $500 or more per share. All right. The value stocks. Oh wait, this is growth. Oops. All right. The value stocks have a low price per earning. So what that means is it's a ratio, and you want to have a. It just means when you look at the price per earnings, it just means that in comparison to another stock with the same growth, it's cheaper to buy this one for the same percentage increase, because you don't have to buy the Amazon and wait for it to go up 4% to make a lot of money. You can have the McDonald's, was MCD, is McDonald's ticker, I believe, which, well, that's in $100 now. It's a cheaper stock. Well, let's just say McDonald's. You can have the McDonald's that might have the same amount of growth, which it doesn't, but you can have it can have the same amount of growth, and it doesn't matter. The thing about stocks is what I tell everybody is that it's not about the amount, it's about how much money you put in, but what really matters is the percentages. The percentage of your loss and growth. That determines everything, because 4% gain on one of these and 4% gain on a stock, a weed stock, and I tell you when I bought and sold was LVV, or you got Aurora, which I don't know the ticker for it, which this stock costs 0.03 cent, 335. That's how much it was per share. So I literally bought 100,000 shares of this and only spent, let's see, you got Gary. I only spent one, two, three, four, five. Put the decimal point there, 0. And I only spent, and I don't know if that's right, it would have been like $3,500. But what I'm saying is, it doesn't matter that the stock only costs a few cents, because if it goes up 4%, that's 4% of what I put in. So if I put in $3,000, that's 4% of $3,000 growth. If I had to put in $100,000 for Amazon, if I put $100K in for Amazon and it went up 4%, it's the same 4%. Or if I put $100K in LBV and I got 1 billion shares and I only have 100 shares of Amazon for $100K, it's still the same $100K and it still went up the same 4%. So it's not about the price of the stocks. It's more about the percentage growth or loss. All right. Income stocks, they pay dividends, same as common stocks. So these are the ones that pay dividends. You call it an income stock because it's gonna pay you. These are the big value stocks. This has a low price per earnings, and these are just, the ones you expect to grow. They grow faster than the market average, and I would say a good growth stock is Netflix. If you watch stocks, that's one. That's an L. That's one that has somehow just come out on top, unexplainably. Not unexplainably, but at some point in time, you would expect it to kind of cap off, because their chart is literally like boom, boom, boom. And it's like, how much growth do you expect? You can only go up so much. It's a few dips in there, but not many. But it's kind of like every time, especially an earnings call, they literally just take off and they just shoot through the roof. And they have a lot of debt, more debt than earnings. So me personally, I wouldn't think that they would do what they're doing, but they're just defying all rationale and beating the odds right now. I have no idea how long this video is right now, so I'm just gonna stop it. You can follow I'm gonna write it out. Foster Investor Group on Facebook. Okay, so Foster, I'm going right. Actually, it's Foster Enterprise Investor Group. On Facebook, my YouTube is where this is posted, but it might be somewhere else. Who knows? You can just type in Elijah Foster on YouTube. Maybe it'll come up, maybe it won't. It's a lot of them out there. It might be a link somewhere in the video. Maybe, who knows? I have a Twitter. I don't talk to people on there. I kind of use it to follow information on different companies and stuff to see what they have going on. But I do post my watch list and things that, or stuff that I'm looking at or into, or things that's kind of going on. If you kind of want to look at my insight, and that one is trading bid. I think it's underscore. These might not be right, not sure. So that is Twitter, which is like a bird. That's the beat. That's the Twitter. This is YouTube. And then this is Facebook. I think Facebook's like that. Kind of big. Hope you learned something. If you got questions, just leave it in the comments. And I'll try to answer that.